Director of Surrey Clean Energy, Meliha Bengali, founder of MB Commodity Corner, and Peter Maguire, CEO of XM Australia. Thanks everybody for joining us today and trying to sort of unpick these dynamics in this now increasingly volatile market, many would say. There's our bulletins for the day, and we just had the survey question about what kind of premium the global spare oil capacity of 5 million barrels a day has trumped geopolitics premium risks and pushed prices back into the 80s. That's our result from yesterday. Most people disagreeing with that spare capacity isn't trumping geopolitical premium risk. We'll have a talk about that a bit later. Adi, let me start with you. We also have had on our headlines there that oil prices settle up a bit on these Middle East worries. We haven't had your take on, you know, how this increasingly alarming sort of tensions in the region, escalating tensions, are impacting the market. Many people are saying risk premium not that high. So why would you say that's proving the case so far?
Yeah, I would agree. I think the risk premium is not that high. When it comes to the current Middle Eastern tensions, it really is all about one word. It's Iran. It's all about geopolitics of Iran. So far, Iran has been restrained, and it seems to me that also Israel, in spite of all the bombing in terms of any ground campaign, that they've also been restrained. Militarily, of course, makes a lot of sense because they don't want to send their own men in a territory where probably many of them will probably get killed. So the tensions come and go. The key is Iran. So far, it seems to be that, you know, whatever the American diplomacy, shuttle diplomacy is doing the magic there, it seems that Iran has been restrained, and I think that's the main reason. So the risk premium has shrunk significantly. I think probably for at least $5 to some $2. That's a very, very rough guesstimate at the moment. But at the same time, everything else has been working in the oil market, as we know. It's not always one factor; it's everything else. And in the meantime, we've had a lot of the other issues that have sort of pressured prices, and the main one being the economic macro situation, which is rather poor, especially in Europe. And I think we saw this week, we saw PMIs coming out, and they were all rather disappointing. I think especially European PMIs with, I think Germany came just over 40, which is quite contractionary. Europe in particular was all about 45, 42. I think France was about 42 and so on. So even the service sector wasn't that great. So Europe, probably recession. Adi, let's remind ourselves it's the biggest economic bloc in the world. So you know that when sort of demand picture is not that great, and we know there's a lot of oil. You mentioned the spare capacity. That risk premium is under pressure.
Okay, thanks, Adi. Meliha, let's talk about the US a bit then. Adi's mentioned Europe and what the sort of status of the economy is there, and the outlook at least. US economy still seeing sort of relatively strong, you know, economic indicators on the whole, you know, including the most recent ones. Where are we with the sentiment there in terms of interest rate policy going forward into 2024, and what sentiment that might be triggering, if you like?
You're absolutely right. Thank you so much for having me on board. So the US economic data is a lot better than Europe. It has been contracting from its higher momentum, but it's still a lot better. Having said that, taking a step back, if you look at all these sort of underlying economic data, the rate of change is, like we like to look at it, it is slowing down. So no one can argue that the momentum is not beat. Now, the big question right now is what's happening in macro. I know I keep on stressing about macro, but it is the driver of all asset classes right now: the dollar, the US bond yields, inflation rate swap. swaps, credit markets. There's so much nervousness, and we've been talking about it for the last few months, if not weeks, in more urgency. The bond market is in disarray. You've seen the back end of the bond market, really move up and down 50 basis points, 70 basis points. These are huge $30 trillion markets. So when these markets move, it's going to have repercussions to our markets. Now, in terms of a slowdown, we think the Fed has tightened way too much. Not many people will agree about this, but the system is snapping and it takes time to show up. So let's filter down to all the asset classes. Going to oil specifically, yes, oil had sort of fallen down from 95 down to 85 prior to the war, the invasion right now. And then obviously we can argue the geopolitical risk premium is probably about $3. But having said that, demand is very important. Taking a step back from the geopolitical crisis, because it's very hard to sort of fathom what can happen, and God forbid anything bad happens, but the demand has been slowing down. So if the demand, the global recession sort of hits the tape right now, and that's pretty much where sell side is confused. Most people think there's a recovery next year, but we're seeing a recession, a hard recession. And that's why oil prices should trade down. So yes, inventories are low, but we think they'll get, the inventory is not our issue. There is no oil shortage in the near term. And I think that's really what our main premise is.
And the other premise is that, of course, OPEC is going to be supporting that price with this much oil still in the market. Exactly. With demand supposedly going to slow down, that key floor, if you like, of $90, we're not there at the moment, but what will continue to be OPEC's intent. Peter, good morning again. Let's go to China. Let's go to Asia and hop across there. Another headline in the news yesterday that China's pledging a new stimulus. I think I have a figure here of $140 billion equivalent. Is that having much sort of impact again on sentiment or reality on the ground? We had somebody on the podcast yesterday who was pretty positive about China going forward, and that it's not as weak. It's not going to be as weak a story as we've been talking about for most of this year.
Well, Diala, lovely to join you from Sydney. If I look at the market today, it's just only down 0.06%, the CSI 300. So it really hasn't. Considering that you've got other markets down 2% and so on with Indonesia, then the Chinese market is probably in good stead. But when you're looking at that, I mean, the overhang, one can't get their mind away from the property sector. So how much do they need to prop it up? And still the talk is, you've got 90 million apartments or homes that are uninhabited. So you've got serious overhang. Who's holding the debt? We're conscious as far as domestic banks, but more importantly, international banks, about 120 of them that are holding that debt. So that's going to be a work in progress, how that all materializes, certainly in 24. I think that the storyline's got to be domestic demand, and because naturally it's pretty weak everywhere else as far as demand picture, inflation still biting hard. It's ratcheting up of rates and cost of living expenses and the cost of oil and all of that to Main Street, the impact it's having to the man and woman on the street. So if the domestic demand, Diala, can get a rocket ship behind it as far as China's concerned, then that's going to be a good move, and they need to get their domestic market going well. And it's just going to be a work in progress to see if that materializes and happens before, say, Lunar New Year, and how the roll-up's going to be, by end of January. If it's not there and it's still functionally weak, then that's going to cause more concern, and naturally they'll have to stimulate far harder to get a bigger result.
Okay, thanks, Peter. Adi, just let's talk a bit about OPEC plus and OPEC plus policy. They obviously have pledged what they pledged through to the end of this year. Questions now arising on what they're like. I know that they kind of take it month by month, but given now that we have this war in the Middle East as well, to add to the Russia-Ukraine war, conflict and bombardment, I should say, for the time being. We do not have a war yet in the Middle East. What impact do you think that could have on sort of OPEC's thinking? I mean, I mentioned before they'll do anything to keep defending this $90. Is that, do you think, required going into next year? We've talked about the risk premium, but what do you think? Anything that's going to change in their thinking?
I think it's a very hard job being inside OPEC right now and trying to make these decisions. And there are no easy answers. I think they'll probably just wait as long as possible and try and get as much information as possible. I think you know what Malia said is quite interesting, because it's definitely a view in the market that we're going to have a hard landing. I don't think we're going to have any hard landing in the United States, but Europe is not looking very good at all. I think macro factors are not particularly clever. Maliha also noticed the movements in the bond markets, and let's face it, flat price is all set up by macro situation, by the financial players. It's not set up by people counting barrels at the front. So that's not looking very clever at the moment. Even some front end sort of going back to counting barrels and sort of physical situation is not looking brilliant either. I noticed that Angolan December programs are out, and November cargoes are not sold yet. And West Africa is usually bellwether of what's going on in the spot markets, because a lot of those barrels are sold spot. They can go either east or west, and at the moment a lot of them are not going either way. So Brent dated is weaker. Naphtha cracks gone negative. Fuel oil cracks are negative. Gasoline is not looking very good at all. Okay, we finished gasoline season, so that's partly not unsurprising, but generally margins are weaker. So it's
what about diesel?
Diesel is looking better. Diesel is the only thing that's holding up the margins. It's still looking very good, primarily due to low stocks. But overall, when you look at everything, sort of macro situation, prompt situation, China initially looked better. It was growing almost 5%, better than expected. At the same time, we haven't seen much Chinese buying. I mean, at this time of year, I would expect Chinese buying for Chinese New Year. They usually buy in advance a little bit more. They build some stocks. I haven't seen much of that actually happening at all. So, overall situation is not that brilliant. And if I was OPEC, I'll just wait and see as much as possible. What
about, sorry, Ali, to interrupt you. What about OPEC's intention to, and I'll just stick with you for now, to alter and adjust these quotas next year? I mean, the UAE has expectations, others perhaps as well, expectations of that. Is that going to come to fruition? We had hints this year that's going to happen.
I don't see that happening before the second half of the year. First half of the year, definitely not. If anything, I think Saudis may continue with cuts, may even have to cut a little bit further. Let's not forget that non-OPEC is just all out there producing as much as they can. I mean, everyone is talking about the shale in the US peaking, but every time they say that, we see record US production, well over 30 million barrels, huge. Guyana is announcing new discoveries, record production, every month. So there's plenty of oil out there.
Okay, Maliha, just on the US again, just as Adi mentioned it, we had these mergers, another merger another takeover, I suppose, announced this week. These majors obviously buying more and more, consolidating more of the US play, and that's kind of sending a signal that we're going to see probably more production come out of the US because there's more control there. Another comment we got this week is that, now that more of the US production is coming under major control, US is not going to listen to what OPEC wants in that sense. If you're thinking about them kind of having listened to that and kept production under wraps for that reason. What's the take from the markets there?
I think the US production has surprised a lot of people. We are right now at 13.3 million barrels per day. A lot of people talked about how US production would fall before the end of the year. It's been quite resilient. Having said that, the cost of oil for producing the US is probably between 45 and 55, I would imagine. So these guys are loving it. In terms of the merger, I think the peak oil demand theory has been pushed out. Like looking at coal as a great example, there is still a need for fossil fuel, and these majors have been terrible at going all clean a couple of years ago. They messed up, and now they're going all fossil fuel. So they've sort of been flip-flopping their strategy, but the story remains the same, that oil's here to stay for a lot longer. We'll produce as much as we can. So I think that's interesting because US policy when it comes to oil, they're not energy dependent anymore. They're independent. So I think that people need to look at how that can actually grow a lot more into future. Now, going back to oil, yes, I mean, after US had shale, the whole sort of relationship between Saudi and OPEC and how much US needed the Middle Eastern oil changed dramatically, right? So the US US doesn't need to worry about that. China, on the other hand, and Adi made a very interesting point, is that China right now has stocked up, and we spoke about this about a month ago on your show. They have about 1.4 billion barrels. They've been stocking. You know, you can ask as to why they have been stocking before the winter, but they don't need to buy all that extra oil. So who's the marginal buyer of oil? And the other thing, which is very, very important, is nobody talks about the link of oil between macro. The higher the oil price goes, the more the emerging markets, Japan and China, all need to sell US treasuries to fund their deficit, to buy the oil. So we're like in a reverse loop right now, where effectively what Saudi and OPEC policy is doing, if I may be so bold as to say, they're making the situation worse by letting oil stay higher for longer, because that's making the job of inflation a lot higher. If they let prices fall, which is what normal economics would suggest, things will equilibrate. But right now you're making that tense situation even tenser, which is basically making the job of the dollar harder, which is going to eventually take oil down. And I've had a lot of talks with people, but they don't understand this doom loop that we're in on the macro and oil side. And I think it's really important to mention that on the show.
Okay, thanks, Maliha. Peter, let's talk a little bit about the commodity barrel, if you like, beyond just oil. Where's the sentiment there in terms of commodities, tracks and indicators? Has the Middle East war pushed the story further that we're going to be risk on for commodities in general, with potential disruption going forward? Has there been any change there in the last couple of weeks?
Well, first off, I'd like to say the US dollar index, we're nearly at 107, Diala. Now, we were down at about 105.50. It's been very, very choppy. You've got a yen sitting above 150 now to the dollar. You've got a euro sitting the best part of 105. 1.0534, and we had a very hot read as far as inflation hitting Australia, and we were thinking you might see a 62 handle. We're at 62.87 Aussie dollar US dollar. So that leads me to the next point, which is gold. We're at record highs in Australian dollars as far as gold, and many other currencies, I believe nearly into the yen as well. So gold has had a dramatic move, and earlier this month we were away. We saw that, I was with you, and the gold cratered and it hit 18.15, and everyone said, oh, its best days are gone and all of that sort of stuff. And well, it's certainly rallied strongly, because you're just sitting under $2,000 now. So there's the first part. Base metals have been flat. They've been punched hard. The likes of copper still at that 8,000 a metric ton. So the demand picture there for base metals has been poor. Iron ore is going okay, but nothing like it was. But the overall theme, I think, has got to be precious metals have just been on fire, and that US dollar's carrying everything. And, the smart money has all been on, if you're a trader, you've been looking at where you're getting movement, and that's been certainly gold and certainly crude, because they've just been blowouts. You had that 95 down to 83 or 84, and then boom, back up, and you're at 90. What are you at now? You're at $90 now on Brent, just under, and you're at 84.5 for NYMEX for WTI. They're just big blows. They're $2 and $3 moves over a couple of days, and that's what traders love.
And I mean, in terms of dollar trajectory, we've now had the sort of new interest rate norm, if you like, settle. Everyone's agreeing it's 5. It could go up a little bit more, etc. We had some comments earlier this week from the likes of Jamie Dimon about where Treasury rates could go in terms of interest there, and prices dropping a bit further. But how much, further have we seen sort of the dollar almost peaking, would you say, because of that? Because, we're not expecting any more interest rate increases in the US, and we're going to see it steady as she goes from now on. What would you put your money on in the year to come, let's say?
Well, if you're saying where is it in a year's time, I think it's up from here. It's at 106.80. Okay. I think by the end of the year, I won't be surprised to take a 108 or a 108.20 handle out. So that's the momentum to the upside. And I think the reasons for that is because of yields, and you've got that cratering, as as Artie said, as far as the numbers coming out of Germany and out of Eurozone are poor. So there's the first part. So I think the flight to safety is going to be US dollar, and that seems to be gathering momentum globally as far as traders. Everything else is being sold off. And equities, I won't be surprised to take another hit to the downside for NASDAQ and all of that, which is, they had a big hit last night. So I think the overall consensus is dollar up, hold on to your hats, possibly gold to rally up. Have a look what's happened to Bitcoin in the last couple of days, 34,500. And you've got to say there's a sense of nervousness on Main Street and certainly on Wall Street.
Yeah, a rush to sort of save other alternative safe havens, I guess. Bitcoin's coming back into fashion, at least for now. Adi, let's talk a bit about Russia and production as we sort of come towards the end of the year. Russian oil obviously still flowing. Premium discounts have changed quite a bit. Give us a picture of how much of that is still going to India, China, and are we seeing any physical impact to Russian production domestically there that's going to perhaps alter flows coming into the first quarter?
Sure. I think short term, I don't see much of an impact. It's business as usual. If anything, these just go back to basics. These Russian flows have stabilized. Russia has managed to sort of avoid most of the sanctions and caps and whatever. We'll come back to that in a second. Establish new trade relationships, and that oil is flowing. Most of the Russian oil since end of June has been trading above price caps. In the east from Kozmino, ESPOs actually never dropped below price cap anyway. So these price caps, I wrote a piece yesterday for CSIS with Ben. We basically agreed that the whole idea of the price caps being to actually allow oil to flow. And I was a little bit involved on the British side in sort of that discussion from the beginning when there was a question whether there should be caps or not. And my point was always, well, caps are not going to help. They're not going to work. Is the EU and UK sanctions and Australia as well, but Australia doesn't really count very much in terms of Russian imports. So anyway, it was a token. So that these sanctions were actually going to hurt Russia. But the price caps were designed to actually blunt the EU, UK sanctions. So to allow the oil to flow, the oil started flowing. And now we have well-established channels. We have a great fleet of vessels. We have alternative insurance. We have alternative banking. And now the best thing would be actually just to get rid of price caps because they're not doing anything, to try and apply secondary sanctions if one wanted to hurt Putin. But I don't see willingness on the side of the US administration to do that, because obviously with the current situation in the Middle East, prices, we already have a risk premium in the oil price. They want to see gasoline prices the lowest possible, allowing Venezuela to Venezuelan oil to flow. That there may be some additional tightening against Iran, depending on how the Middle Eastern situation pans out. So I don't see any willingness on the side of Biden administration to tighten those Russian caps or sanctions. So I think just more of the business as usual, and the more these flows from Russia get established, I think, this just be business as usual. Longer term, I think Russia without Western technology is very unlikely to increase their production capacity. In fact, it's going to probably drop a little bit. But, that's primarily because all the new production from Russia was going to come from, challenging areas, especially in the north and Arctic. But conventional oil will keep on flowing, and I think Russia will keep on maximizing that flow in order to maximize the revenues and fund the war in Ukraine.
Okay, Peter, I'll just go to you just to talk about gas a little bit for Asia, but in the context of Europe as well. I mean, we just heard Adi's comments on oil, but we had somebody earlier on the program this week saying that gas in Europe is looking very relaxed in terms of the market. Premiums against spots are pretty low, for even into the first quarter. What's the picture in Asia in terms of gas supply, gas premiums, risk there? Europe is a bit more comfortable this year going into winter than it was a year ago.
Well, exactly. That's the sort of the storylines that I've been reading, and it's making a lot of sense. After reading it, I was quite surprised because it took me, it said, February, March, there's really no issues as far as, across the European frontier for gas. And I was thinking, well, a couple of things that really sprung to mind were the Chevron issue and out of Western Australia, and they had those union issues only going back to the start of September, and then they seem to have well, settled down, and then they flared up again. And now, by the looks of it, they've settled down. I think there's two fields there, Gorgon and the other one. I'll think of it in a second. And so that was a good point. And the overall, I think, obviously from a supply side, if there's not any issues, then that's going to be good for a European winter. And our exports, because we provide about 20% of the world's production, I think Qatar's 21% and the US is about 19% or around that. The three of them, they're the first, second, and third. And as far as Asian demand, well, that seems to be fairly as strong as ever, considering Japan and the situation across a number of other Asian nations. So I think that's a good point, and that's good. We don't need to see, because that was always consensus or a troubling thought putting your mind back a year ago, Diala, that there's going to be mayhem across Europe. There's going to be no gas. Well, at the moment, that doesn't seem to be an issue. So let's just hope that it's a mild winter from a weather perspective, and they're not going to have any issues as far as, getting supply.
Okay, I think the survey question is coming up now. I can't seem to see it on my screen, but I don't know if anyone else can see it. Can everyone else see the survey up?
I answered it.
No. Okay. Okay. I didn't see it, but can you put it up again, Madeleine? Because I missed that. Maliha, just talking about, just sticking to the gas story a little bit more. We have the EU. We have a headline today which says EU to increase LNG imports from Nigeria. Long-term imports from 2023-27. We also had the EU doing a deal with Qatar again for long-term supply. Again, putting that into the context of how Asia might be feeling. Will Asian consumers feel a bit more relaxed, that they'll have possibly more leeway with spot cargoes that might be in the market, with Europe kind of now maybe drawing less on those and thinking more about its long-term perspective?
You're absolutely right. There'll be a lot less pressure, because last winter we saw the triple whammy effect, right? You had a pull from Asian demand, LNG, Europe was trying to struggle, and all the US cargoes went there. So it's getting a little bit more balanced in the sense that I think supply chains have changed for the long term, and we know that. A lot depends this winter, as Peter mentioned, on winter demand and in terms of the pull and the Asian recovery, because we still could spiral out of control if there's a pull in all directions. Yes, they made much better, improvements in terms of not being reliant on just one supply like Russia. But I don't think the whole energy gas crisis is not really over in EU, but certainly the estimate of recession and probability and the impact of gas is a lot less, because Europe is slowing down, and that will hit the industrial demand as well as residential demand. So we need to put all that in perspective. But yes, things have made it a little bit easier for them because they made these long-term relationships. But there's so many moving factors in the future that I think we take one winter at a time to really see the impact of gas prices in the economy.
Maliha, what's your view on Chinese economy going forward as well? We got a few comments earlier from Peter, but in terms of the outlook there now, I know they still have these property concerns, property sector concerns, but which side of the camp would you be on in terms of, would you be more positive or negative next year for the recovery story, if you like, out of China?
I think China is a bit of a pickle, and Xi Jinping knows it. They're trying every what sort of thing they can possibly throw at the market right now, and I think they're a little bit too late. Now, this is a bit contentious. A lot of people have put their estimates for end of this year and early next year in China recovery. People put in a China recovery without really understanding what's happening in China. Right now, the last 1 week and a half, China has thrown in about 1.2 billion yuan at the market. It's not rallying. They've thrown all these like property measures. It's not rallying. The domestic consumer in China is very dented. There's a lot of uncertainty. The yuan right now is massively depreciating. So the question is, the China economy, they have this very delicate task of throwing more money at the problem, where they have debt is a huge problem, or containing the slowdown. I think it's a bit of a ticking time bomb. It's very hard to tell because a lot of the data is very opaque, but we do not think they're as bullish as people think they are. And I think the whole global economic crisis is actually impacting China. China really is not as independent. It needs European exports. It needs US economy. So we think things are a lot worse. And maybe in the next few weeks, we'll see what they do. But if they come back with the bazooka stimulus, guess what? It'll be massive inflation again, and a dump later on. So no, I'll be a lot more bearish in China, and we have been for the last few months. We've seen that slowdown.
Adi, just back to you on China. We had somebody this week who was on an interview, halftime talk interview, who was saying that the Chinese electric vehicle market, as we know, a lot of investment going into that, booming big time. And in that context, that if we do see now yet another Middle East war, that's it. Consumers are just going to say, really, we're just fed up with oil. We cannot keep, being triggered like this. And that is going to really trigger us much accelerate the transition argument for big consumers like China, bring the net zero pledges forward 20 years, etc. Do you think that's realistic with all the talk about, no, we need oil, we're not at peak oil, the emerging markets will not be able to do that anyway, etc. How much do you think there's still movement on that front, if you like?
I think that I do have some sympathy for that argument, because I think EVs have actually surprised in the past, and I think will continue to surprise. I don't think the current OPEC policy is really helping that transition to EVs. I don't know what other consumers think, but I'll tell you what, my next car is going to be an EV for sure. Especially given that it's all linked to Chinese situation in an indirect way, because as China is slowing down, I think they're under pressure to export more. The problem in Europe, for example, where EVs are picking up quite a lot, US in particular, is that EVs are very, very expensive. Over here, an average EV is about £30,000, which is what, $35,000+. In China, an average small EV is about $10,000. I'll tell you what, Diala, if I could buy an EV here for $10,000, I'll just buy one for fun, just see how it works. So, as we see this flood of Chinese EVs in the US and Europe, and of course, both are trying to stop it to protect their own industries, we will see a huge uptake of these EVs. And I actually, if anything, I'm quite bullish. And I do see that side of the argument. I'm fed up with oil prices going up and down, even though it's my sort of livelihood and I should know where it's going. But, it's just been a little bit too volatile. And there's so many new announcements in terms of technology. Toyota came out a couple of days ago saying they're going ahead with the commercial production of solid state batteries, which is a huge breakthrough. I mean, they can do 1,200 miles or something. They can charge within 3+ minutes and so on. I mean, if we see that kind of breakthrough in the next year or so, I think it's going to be a major impact.
And if we fast forward even 5 years, we could have a huge, very different picture. Maliha, we've run out of time, but very quickly, I'll go to you for one comment. Will we see $100 oil this quarter? Only a month ago, people were saying, yes, we're on our way there. Are we going to now see it? Seeing as we've dropped
this quarter, end of the year, no. Next year, I mean, providing there's no war, because if Iran and all get involved, all bets off. From a pure economic point of view, we will not see $100 oil. I think we're in much more downside.
Okay, thanks very much to Maliha, Adi, and Peter today for joining us on the podcast. Thanks so much, everyone. Have a great day.
Thank you, Diala. Bye. See you guys.
Bye-bye.
See you, Thanks, Malia.